welcome back to the Deep Dive. If you feel like the world of technology, and particularly artificial intelligence, is accelerating at a rate that is, well, frankly impossible to track, you are definitely not alone.
Not at all.
The shift is so profound, so fast, it's less of a steady evolution and more of a sudden phase transition. Every single week brings staggering investment news, unexpected breakthroughs, and these massive capital movements that are fundamentally redrawing the global economic map right under our feet.
It is, and this isn't an exaggeration, perhaps the most important technology race of our lifetime. And what's absolutely crucial for you, our listeners, especially those of you tracking where the future economy is being built, is understanding the flow of that capital.
Right. Where's the money going?
Exactly. Where are investors placing their high confidence bets? Because those dollars and cents at the end of the day are the ultimate indicator of where the next major technological superpower is emerging.
I'm glad you put it that way. And today, we are zeroing in on a region that is often discussed for its incredible growth potential, but is, I think, rarely singled out for leading the global tech charge. Southeast Asia, SEA.
Yeah.
We're moving the spotlight away from the familiar giants, Silicon Valley or Shenzhen, and we're going to focus intensely on what are probably the fastest growing and most dynamic digital economies on the planet right now.
And our mission today is to take a magnifying glass to a really surprising piece of data, a piece of data that reveals a major geopolitical shift happening as we speak. Our analysis is pulled primarily from the AI News Daily Digest, which, synthesizes key findings from the highly influential e-Conomy ASIA 2025 report.
Which is that big collaboration between Google and Temasek, a really robust source.
A very robust source. It tracks digital economics across the whole region, so these sources give us an authoritative, almost real-time look at the investment landscape.
And we've tracked these economy reports for years, and they usually showcase this sort of uniform growth across the major players. But this year, the data contains a single jaw-dropping statistic that demanded we do an entire deep dive just on its implications.
It really did.
It's a data point that signals an almost stealthy but undeniable shift in tech leadership within SEA, and it challenges decades of the established regional hierarchy.
The goal precisely is to unpack that statistic. We need to go beyond the simple number and really dissect the mechanism of success. It's a revelation that drastically redefines who is currently winning the high-stakes competition for attracting global AI investment in Southeast Asia.
Okay, so let's stop delaying the inevitable surprise. When you look at the SEA map, it's a diverse region. You've got massive markets like Indonesia, stable financial hubs like Singapore, emerging economies like Vietnam. Which nation over the last 12 critical months managed to set the pace? Which country is suddenly dominating, and I mean dominating, the influx of AI funding?
The country that has completely rewired the regional dynamic and the focus of our deep dive today is Malaysia.
Malaysia.
And when you look at the quantum of funding they captured, the immediate question shifts from just, curiosity to this intense strategic inquiry. How did they manage this sudden, intense acceleration, this concentration of capital?
That is the essential question. Because for a lot of people who track global innovation, Malaysia might not have been the immediate assumption for the regional AI leader. You'd probably think Singapore, right? Because it's regulatory stability.
Well, Indonesia, the sheer market size.
Or Indonesia, exactly.
Yeah.
But the hard data, it just overrides all those assumptions. So let's first establish the broader context here, this highly competitive AI race happening in SEA.
Absolutely. The first step in appreciating the magnitude of what Malaysia achieved is grasping the intensely competitive environment they're operating in. The broader trend across all the sources is it's unambiguous.
What is it?
Digital economies across Southeast Asia are intensely, almost frantically embracing AI. This is not some slow exploratory adoption curve. This is an urgent strategic necessity, and it's driven by global pressure.
And the core motivation isn't optional, right? It's about future economic security. The analysis across all the source material points out that AI adoption is just. It's crucial. It's crucial to boost efficiency, innovation, and overall competitiveness.
It's about survival, in a way, securing their economic future, ensuring their workforces remain relevant, and optimizing these incredibly complex supply chains against, increasingly aggressive global competitors like China and the U.S.
That is the perfect framing for it. Think about the enormous logistical challenges across AG. You've got dense populations, really complex geography, rapid urbanization.
Yeah.
AI offers these unprecedented solutions for optimizing everything.
Yeah.
Traffic management, personalized education, cross-border e-commerce, sophisticated financial services.
Every government in the region recognizes this. They see that AI is the engine driving modern productivity. And that recognition, that creates a highly attractive, yet ferociously competitive environment where global capital is aggressively seeking promising jurisdictions to invest in.
So we have this backdrop, a high-stakes regional arms race where every major economy is actively implementing policies, dedicating massive resources to attract that global capital. This is that broader shift the source material talks about.
Everyone's in the race.
Everyone is running the race, trying to capture market attention, which makes the next data point such a massive disruption to what everyone expected.
It is the shocking revelation. It's the thing that changes the entire strategic calculus for the region. Because despite all that competition from much larger markets in these historically entrenched financial centers, when you look at the distribution of that investment, one country achieved a totally disproportionate outcome.
And here is where the conversation turns from that big regional overview to a really focused analysis. The central disruptive data point that positions Malaysia as the unexpected, rapid regional leader is its staggering share of the capital flow. In this highly contested region, grappling for every single dollar, Malaysia secured a remarkable 32% of Southeast Asia's total AI funding over the past year.
Let's just pause on that percentage for a second because its implications are vast.
32%.
32%. Southeast Asia has 11 distinct markets. To secure nearly a third of the region's entire AI investment into a single market, and to do it in just 12 months, that's not just a statistical outlier, that is a strategic triumph.
It really is. It signals that while competitors were maybe focused on policy or just planning, Malaysia was in active, successful execution mode.
That's it.
And crucially, that 32% is a gigantic chunk of what is rapidly becoming the world's fastest-growing regional tech market. It implies a profound level of confidence from large-scale global investors. We're talking venture capitalists, private equity, major tech corporates.
Right. And they're all basically saying that Malaysia provides the most reliable, the most fertile, and perhaps the most bureaucratically streamlined ground for immediate AI deployment.
It is the ultimate validation that their focused local AI strategy is just generating results that are far outpacing their immediate and often much larger neighbors.
And success creates momentum. This 32% figure doesn't just represent past investment. It establishes the starting line for the next phase of the race, with Malaysia suddenly miles ahead. So now we have to move to the specifics, the dollars, the timeline, and the how.
Okay, let's transition from percentages, which can feel a bit abstract, to the concrete financials. Because understanding the sheer dollar amount here makes the scale of this influx truly tangible for everyone listening.
The numbers absolutely confirm the scale of both their ambition and their success. The source material specifies the exact quantum of the influx, a staggering US $759 million.
$759 million US dollars. That is nearly $750 million dedicated specifically to AI investment.
That's right.
That means funding everything from research labs and advanced talent acquisition to the actual physical infrastructure you need to run AI at scale, all flowing into one country in this specific region.
And as we stressed earlier, the timeline is arguably even more critical than the total sum. This $759 million was captured specifically between the second half of 2024 and the first half of 2025.
So a very tight window.
A very tight 12-month period. That is the key to understanding the intensity. This is not slow, steady, calculated growth over 5 years. This is an intense, concentrated infusion of capital that suggests a major coordinated event took place.
Okay, let's drill down on that 12-month window. Because when investment is compressed into such a tight timeline, it signals something specific about the investor mindset, right?
It does.
It means immediate high-confidence bets that expect a rapid and large-scale deployment of that capital. So what does that timing suggest about Malaysia's strategy? Did they just capitalize on regional delays, or did some specific government initiative align perfectly with the global VC cycle?
I think the sources implicitly suggest it was both a perfect storm. A sudden spike of this magnitude means that multiple large-scale funding rounds, perhaps tied to government matching grants or massive corporate regional HQ commitments, all materialized at the same time.
Wow.
This validates Malaysia as having perfectly timed its policy introduction to meet that global investment hunger for scalable AI solutions. It suggests a high degree of regulatory foresight and political stability during that exact 12-month period, which made it a safer bet than competing jurisdictions at that exact moment.
That makes perfect sense. Investors see speed and stability. If they have capital ready to deploy, they will choose the jurisdiction that can guarantee the quickest route from a funding commitment to actual operational capacity.
Of course.
The suddenness of that $759 million arriving speaks volumes about a successful, immediate pitch to the global investment community.
And we should also consider the source of this capital. While the report may not name specific funds, to hit $759 million, you're looking at a mix. It's not just small seed funding.
Right.
This includes significant corporate investments, big tech placing regional data centers, and potentially large sovereign wealth fund commitments, which signals state-level backing that minimizes investor risk. This mix means long-term commitment, not just some speculative VC play.
So let's connect that dollar amount back to the 32% figure, securing almost a third of the region's AI funding. That fundamentally changes Malaysia's global identity in the tech world. It moves them from being just a strong emerging market to being a declared regional tech power.
Absolutely. The source explicitly uses very deliberate language here. It calls this a demonstration of Malaysia's burgeoning role as a powerhouse in AI development and investment.
Powerhouse is a strong word.
It's a strategic designation. It suggests they are now capable of shaping regional technology trends, attracting specialized, high-value talent, and even dictating competitive terms.
And the word burgeoning, that's key too, isn't it? It implies this isn't some one-off peak. It's the beginning of a larger, potentially self-reinforcing trend.
That's right. For global institutional investors, this 32% data point makes Malaysia unavoidable when they're looking at regional portfolios. You simply cannot analyze SCA tech investment now without prioritizing this market.
So the analysis for that external capital becomes dramatically simpler. The technical infrastructure and the market readiness they're proven.
They're proven. The high percentage acts as a risk mitigator for future investors. It indicates a critical concentration of success, of talent, and of governmental commitment, creating a momentum that then pulls in yet more investment. It's the definition of a successful investment flywheel.
I think we need to challenge that idea for a moment, though.
Yeah.
While the numbers are staggering, couldn't this 32% just be an anomaly? Maybe it was driven by one massive, non-replicable deal, say a single hyperscale data center announcement that just skews the figures for 1 year.
Yeah.
How reliable is this as a long-term trend indicator rather than just a massive short-term success?
That is a critical piece of skepticism, and we have to address it. If this were solely based on one non-AI specific infrastructure deal like a generic manufacturing plant, then yes, it could be an anomaly.
Okay.
However, the report specifically tracks AI funding. This implies the $759 million is directed toward AI-specific use cases. R&D centers, specialized AI cloud infrastructure that requires specific GPU stacks, or large foundational model development.
So it's not just concrete and steel.
Exactly. So while a single massive deal might anchor the number, the fact that the two engines of success, infrastructure and adoption, were operating at the same time, which we'll get into, suggests systemic readiness. Not just a lucky bid for a factory.
That distinction is so important. It speaks volumes about the governmental and regulatory alignment. To attract nearly $760 million in such a short period for AI purposes, you need more than just good business plans from companies.
You need a lot more.
You need streamlined regulatory processes that specifically favor advanced data handling. You need trusted data privacy frameworks. And most importantly, a clear national mandate that prioritizes AI development.
And when a country explicitly goes after a powerhouse designation, it implies a multi-year strategy that was just executed with incredible speed. The funding milestone shows that their initial critical steps were executed with devastating efficiency.
They laid the groundwork.
And the global investment community responded with overwhelming, immediate validation.
So the immediate takeaway from this section is just indisputable. $759 million in 12 months, securing 32% of regional funding, is a strategic marker of both intent and execution.
Yeah.
So what is settled?
That is.
Now we transition to the vital question, the how. How on earth did they manage to capture such a significant slice of the AI funding pie and overtake their regional rivals?
This is where we get to dissect the strategic advantage, the secret sauce, that was identified by the e-Conomy AFA 2025 report. And the success wasn't due to luck. It was a perfectly engineered, synergistic combination of two fundamental, mutually reinforcing strategic factors. This is the playbook for modern technological ascent.
Well, let's dive deep into the first engine, which sounds like it was both enormously expensive and probably politically difficult to coordinate. Aggressive infrastructure expansion. What does aggressive really mean in the context of building a national AI ecosystem?
In the context of global tech competition, aggressive is absolutely the operative word. It signals to international investors three things: speed, scale, and proactive commitment.
Speed, scale, commitment.
That means the government engaged in proactive planning, allocated substantial capital, maybe even subsidized capital, and implemented a focused, fast-tracked strategy to build the necessary technological foundation ahead of the curve, not reactively.
So they didn't wait for, say, Google or AWS to come knocking and say they needed a new data center location. They built the foundation first, making themselves irresistible. So what does that aggressive infrastructure actually entail for attracting high-level, resource-intensive AI capital? How does it de-risk it for investors?
This is where we need to get a little bit technical. For attracting AI investment, infrastructure goes far beyond just standard power lines.
Right.
It needs foundational elements that are critical for intense AI workloads. This includes, first and foremost, hyperscale, Tier A data centers with industrial-grade, reliable power supply and specialized cooling systems necessary for large GPU clusters.
Because these models just burn a tremendous amount of electricity and generate immense heat.
Immense heat. Aggressive expansion means guaranteeing that capacity is there, ready and waiting.
And the GPU stack is key here, isn't it? AI isn't run on standard CPUs. Attracting investment often means securing access to those high-demand, specialized silicon chips that are necessary for training and running large language models. Does aggressive infrastructure also mean creating favorable conditions for securing that supply chain?
Absolutely. The infrastructure includes the digital and the regulatory pipelines to import and utilize these specialized AI processors at scale. Furthermore, it means high-speed, low-latency fiber optic networks.
Okay.
This requires an extensive national fiber rollout, but more importantly, securing new international cable landing stations that connect Malaysia directly to global internet backbones, bypassing any regional choke points. This guarantees the low latency that's necessary for real-time AI services.
That directly addresses the investor risk. I mean, if a tech giant is deciding where to place a regional AI hub, they're looking for guaranteed uptime and low latency.
They have to have it.
So aggressive infrastructure assures them that they won't be bogged down by regulatory delays or power issues that could cripple their billion-dollar AI models. It's a massive de-risking tool.
Precisely. It mitigates deployment risk. The source notes that this infrastructure expansion is rapidly transforming the technology landscape in the country. That rapid transformation sends a very strong, very strategic message.
Which is?
We are serious, we move fast, and you can deploy your capital here immediately with minimal delay. Speed means reduced time to market, which translates directly into higher investor returns.
I want to push deeper on the policy side of aggressive. What specific governmental policies would accelerate this? Are we talking about specific incentives like tax holidays, or are we looking at regulatory streamlining like expedited zoning permits for data centers, which often face lengthy local resistance?
You've hit on the vital soft infrastructure component. Aggressive expansion almost certainly includes a few critical, often hidden policy moves.
Like what?
Targeted tax holidays for companies investing above a certain threshold in AI-specific R&D or data center construction. Expedited zoning and permitting, meaning what takes 5 years elsewhere, might take 6 months in Malaysia for these strategic projects, and potentially energy subsidies or guaranteed long-term power purchase agreements, PPAs, to lower the enormous operational costs of running an AI center.
Right, which minimizes the bureaucratic friction.
Yeah.
That is highly, highly appealing to international investors who are working on tight schedules and massive budgets.
It is.
So Engine 1 creates the necessary supply, the high-powered physical and digital pipelines needed to run heavy AI models and store massive data sets. That's a huge investment. But supply alone cannot justify $759 million. The money has to see a clear path to generating revenue.
That's right.
Which brings us to Engine 2, the high rate of consumer adoption.
This is the absolutely critical demand-side factor that seals the deal for investors. A high adoption rate means investors aren't just betting on governmental commitment. They see a ready, receptive, and sophisticated market for AI-driven products and services.
Right. They are investing in an active user base that generates the necessary data to train and refine new AI solutions.
Consumer willingness is the ultimate proof of concept. If Malaysian consumers are quick to integrate AI into their daily lives, whether that's through advanced mobile fintech apps, hyper-personalized e-commerce, or using AI for education, it drastically reduces the market risk for companies operating there. The barrier to entry for new AI products is just lower.
And that high adoption rate suggests several things about the Malaysian population that are very attractive to investors. high digital literacy, a comfort with new technology, and crucially, a highly active mobile-first user base. This makes it an ideal testing ground and launchpad.
But the hidden value here is the data, isn't it? High adoption means continuous high-quality data streams being generated.
And that data is the fuel for the AI engine. If you're building a foundational model for the ASEA region, you need massive localized data sets to train it effectively.
You can't just use American data. No. High consumer adoption guarantees that local data supply, which is the key to attracting the largest tech giants, who aren't just selling a product, they are building a regional knowledge base.
So the synchronization is what made that 32% figure possible. The supply, the aggressive infrastructure, gave the tech giants the technical capability to run a regional headquarters capable of massive data processing.
And the demand, the high consumer adoption, gave them the market justification to use Malaysia as a pilot market before scaling their AI solutions across the rest of Southeast Asia.
So we're talking about a perfectly calibrated tech ecosystem where the physical pipes were big enough and fast enough, and the customers were lining up immediately to interact with the AI-driven services being pumped through those pipes. That dual approach is absolutely essential.
It creates a self-sustaining investment flywheel. Infrastructure attracts capital and talent. Adoption drives revenue and high-quality data. The revenue and data then justify further infrastructure upgrades and deeper capital investment. This is why they secured nearly a third of the funding. They de-risked the investment better than any of their neighbors by demonstrating readiness on both the technical or supply and market or demand fronts at the same time.
I have to ask, though, about the sustainability of Engine 1. Aggressive infrastructure expansion, especially when it's subsidized or accelerated by government policy, is incredibly expensive. Is there a risk that this initial surge is heavily reliant on temporary large-scale public investment that just can't be maintained? If the government pulls back on the tax breaks or the energy subsidies, does the investment immediately dry up, making that $759 million a one-time blip?
That is the critical risk assessment any long-term investor has to make. The long-term viability depends on the private sector stepping in to maintain that momentum. However, the high consumer adoption, Engine 2, provides the necessary guarantee against that risk.
How so?
Well, if the infrastructure build-out successfully attracts the global tech giants, those private companies will then have the incentive and the deep pockets to fund the next wave of infrastructure themselves, simply to service their existing high-revenue user base.
Oh, I see.
The government's role in this model is to shoulder the initial highest-risk investment to kickstart the flywheel. The fact that $759 million flowed in so quickly suggests that global capital now trusts that the government's initial investment has created a self-sustaining momentum.
That makes the synchronization even more impressive. It implies a coordinated national strategy where the government facilitated the physical investment while also focusing on things like digital literacy campaigns and consumer-friendly AI policy, maximizing the public's readiness. That $759 million is truly the payoff for strategic execution across multiple ministries and sectors.
This dual engine is the primary lesson for other developing digital economies. It shows that focusing on just one factor, say only market size like Indonesia or only financial regulation like Singapore, is insufficient. You have to integrate physical readiness with digital readiness.
Okay, let's move now to what this spectacular success means for the region as a whole. Because when one player accelerates this quickly, it creates massive strategic dilemmas for everyone else.
Malaysia's success sends a tremor across the entire SCA technology landscape. The source analysis states it very clearly. Malaysia sets a compelling example for its neighbors.
A compelling example is a very diplomatic language for a new, incredibly high benchmark that everyone else must now chase. So what exactly is the critical lesson this sends to the major economic players in the region, Indonesia, Thailand, Vietnam, and even an established hub like Singapore?
The lesson is direct, it's actionable, and it's financially quantifiable. Strategic, focused investment in AI infrastructure, coupled with policies that foster consumer adoption, yields substantial economic rewards and opens the way for transformative technological progress.
It moves AI policy from being a theoretical white paper to being a direct, financially measurable engine of foreign direct investment.
Exactly. It demonstrates that prioritizing AI is not just a defensive measure, to keep pace with global trends, but an aggressive offensive strategy to gain regional market share and attract that crucial foreign capital.
And the economic rewards here are immediate. $759 million is a massive injection. It creates high-value jobs, enhances skill sets, and fundamentally modernizes their productive capacity.
And this success story creates immense competitive pressure. It forces other regional governments to rapidly reassess their own AI strategies. If a neighbor was previously, let's say, tentative about committing large public funds to aggressive infrastructure, or if their digital adoption strategies were fragmented,
Yeah.
Malaysia's 32% market share now acts as a loud, high-stakes wake-up call. They risk being left behind as capital and talent concentrate around this new powerhouse.
This shift is fundamentally changing Malaysia's role in the regional hierarchy. The source makes a clear distinction about their new positioning. They are no longer just competing.
No, they are defining the race. Malaysia is positioning itself not merely as a participant, which just implies keeping up with the pack, but explicitly as a leader driving innovation and growth across Southeast Asia. That's a fundamentally different mandate. It carries both opportunity and responsibility.
And being a leader means setting the standards for regulation, attracting the top global talent who want to work at the most funded and fastest-growing hub, and becoming the primary destination for regional M&A activity in the tech sector.
It establishes a center of gravity for AI innovation in CA.
And this new leadership role, it must introduce massive competitive dilemmas for their neighbors. Let's take Indonesia, a huge market, immense consumer data potential. Indonesia's government might now feel compelled to match Malaysia's infrastructure investment, but doing so means diverting massive public funds away from other pressing development needs. They're forced to play Malaysia's game, which is built on speed and specialized infrastructure.
That's their dilemma. And what about Singapore? Historically, the region's undisputed financial and regulatory hub,
Right.
Singapore might struggle to compete on sheer scale or just land availability for massive data centers. Its challenge is different. How does it leverage its existing financial stability and top-tier talent pool to differentiate itself? Perhaps by focusing on highly specialized niche AI sectors like governance or financial risk management, rather than trying to match Malaysia's general hyperscale approach.
That is exactly the strategic pivot Singapore has to consider now. Malaysia's success exposes where Singapore is weakest in providing the vast physical space and cheap power for industrial-scale AI processing. Meanwhile, for emerging economies like Vietnam, Malaysia provides a clear, replicable, albeit very difficult playbook for how strategic planning can overcome incumbent advantages.
The power dynamic is shifting. It's shifting from one centered on financial regulation, which was Singapore's strength, or market size, which was Indonesia's, to one centered on speed of execution and infrastructure readiness. That's Malaysia's new game.
And that changes regional competitive strategy profoundly and immediately.
It necessitates an region-funded response. The neighboring countries must now either double down aggressively on their own dual strategy infrastructure plus adoption, or they risk losing further ground and seeing the best AI talent and capital concentrate permanently in Malaysia.
So the goal for them is no longer merely participating.
No, it's catching the leader that just accelerated to jet propulsion speed.
Let's look at the future trajectory then. The sources conclude the analysis by summarizing the forward-looking statements from the e-Conomy SE 2025 report.
And the funding milestone is described in highly optimistic terms. It is both a testament to its growing influence and a powerful beacon of potential for the entire Southeast Asian region.
That confirms it. The success isn't viewed as an anomaly that will fade, but as a confirmation of long-term strategic viability. And it's replicable.
That's the key.
A beacon of potential suggests that Malaysia's model offers a clear, proven pathway for others. It serves as a proof of concept that strategic, targeted government-backed initiatives, when they're synchronized with market readiness, can successfully capture massive global tech investment.
Furthermore, the report's conclusion confirms the positive long-term outlook, saying, quote, "The future of AI in Southeast Asia is bright and full of possibilities." This optimism is fueled by the understanding that if one country can achieve this level of concentrated, rapid success, it proves the regional market is right, it's stable, and it's desperately eager for transformative AI technology. The $759 million is simply the beginning of a larger, regionally transformative trend.
The possibilities are enormous, especially when you consider the scale of the digital economies in SEA. Successful implementation of AI, piloted effectively in a market like Malaysia, can lead to massive efficiency gains that allow these nations to potentially leapfrog traditional stages of industrial development.
It's a true technological transformation with generational impact. The future trajectory, based on these sources, involves continued rapid investment. Malaysia has proven the model works. The question now is not if the region will invest in AI, but how quickly and how effectively the other major nations will adapt Malaysia's dual-engine strategy, which requires massive, difficult infrastructure spend to claw back some of that remaining two-thirds of regional funding.
They've shown the optimal playbook.
They have, for the immediate future.
Okay.
And now the competitive clock is ticking for everyone else.
What a phenomenal breakdown of this massive shift. It completely redefines how we have to view Southeast Asian tech dynamics. Okay, can you give us a final synthesis, a succinct recap of the most important elements for our listeners today, combining the what and the why?
Certainly. The critical takeaways are four interconnected strategic elements that really have to be understood together. First, the specific achievement. Malaysia secured 32% of regional AI funding.
30%.
Second, the hard data that validates this, that staggering US $759 million influx. Third, the strategic speed. This massive capital injection happened over a tight, high-confidence 12-month period between H2 2024 and H1 2025.
The speed is key.
And finally, the essential mechanism of success. The perfect synchronization of the dual engine's aggressive, targeted infrastructure expansion meeting high consumer adoption, which together minimized risk and maximized opportunity for global capital.
That is a phenomenal shortcut to being well-informed on this topic. The utility of this knowledge is immense. You now understand exactly where the next major technological power shift is occurring in Southeast Asia, why that specific country is winning, and what the playbook looks like.
That's right.
This is crucial knowledge for anyone involved in regional investment, policy setting, or competitive analysis. You are now positioned to understand the next big moves by Indonesia and Singapore.
Indeed. It's no longer sufficient to simply track the global tech giants. You have to identify which regional players are executing strategies so effectively that they are drawing the exclusive attention and capital of those giants. Malaysia is the case study for rapid, focused technological ascent in the current market.
Achieved through a bold, integrated national strategy. And as we close this deep dive, we are left with a provocative thought that builds directly on the implications of the source material. If strategic, aggressive investment in both supply, the infrastructure, and demand, the adoption, is the key to attracting AI capital, Malaysia has effectively started a massive high-stakes infrastructure race among its neighbors.
That is the pivotal competitive question for the next 12 to 24 months. Malaysia has captured 32% of the initial prize. The remaining 68% of regional AI funding is now fiercely contested.
Right.
So, will we see an immediate, aggressive, and perhaps financially unsustainable response from the other major SEA economies, forcing them into a massive infrastructure build-out? Or will Malaysia consolidate its lead, creating an unassailable regional concentration of AI power? That is the competitive dynamic that you, the listener, need to watch unfold next, because the fate of billions of investment dollars and the technological future of Southeast Asia hangs in the balance.
Fantastic analysis. We'll be keeping a very close eye on those competitive dynamics right here on the Deep Dives. Thank you for joining us.